If you're listening to this in January, there's a decent chance you already feel behind. Maybe you've seen the headlines about new IRS changes. Maybe someone told you this is the year audits are going to skyrocket. Maybe your inbox is already filling up with tax emails, software reminders, or panic posts that all seem to say the same thing. Don't mess this up. And if that familiar tight feeling just showed up in your chest, I want you to pause for a second. Because tax season is loud, but it is not chaotic. And it is definitely not designed to trip you up. Welcome to tax season 2026, which means we are filing 2025 tax returns. And today we're going to talk about what's actually new, what's actually the same as last year, and what really matters if you want to get through this season without spiraling. This episode is not about hacks, it's not about fear, and it's definitely not about rushing. It's about clarity. By the end of this episode, you're going to understand what tax season really is, why January feels so intense, and how to approach the next few months calmly, whether you're an individual filer, a small business owner, or both. Let's start by grounding ourselves in reality. First, let's get our language straight, because this matters more than people realize. Tax season 2026 is not about 2026 income. It is about 2025 income reported on tax returns that are filed in 2026. That sounds obvious, but every single year I see people mentally jump ahead and confuse themselves before they even begin. When you understand what year you're dealing with, everything else starts to feel more manageable. Now here's the part that doesn't get talked about enough. Tax season is one of the most predictable processes in the federal government. The deadlines don't change. The structure of the return doesn't change. The way the IRS processes returns doesn't suddenly reinvent itself every January. What does change is the noise. January is when forms start arriving at different times. Employers finalize payroll data. Banks, platforms, and payment processors issue 1099s. Software companies start marketing hard. Social media fills with the worst-case scenarios. So it feels like something big is happening. But structurally, tax season is a repeatable process, and understanding that alone can lower your stress level by about 50%. January isn't chaotic because taxes are harder. It feels chaotic because information arrives unevenly. Some people get their W-2s early. Some don't get corrected 1099s until February. Some small business owners have books that are already reconciled. Others are staring at a year's worth of transactions for the first time. That unevenness creates comparison, and comparison creates panic. You start thinking, everyone else is already filing. I'm behind. I should hurry. But here's the truth most people don't hear. January is not a race. The IRS doesn't reward speed. They reward accuracy, and they absolutely allow time. Now let's talk about what stayed exactly the same, because this is where a lot of unnecessary fear creeps in. The core structure of the tax return is unchanged. Income is reported, deductions and credits are applied, taxes calculated, payments and withholdings are reconciled. The filing deadline is still the filing deadline. Extensions still exist, payment plans still exist, correction processes still exist. And most importantly, mistakes are still fixable. Tax season is not a one-shot, irreversible event. It's a process with built-in correction mechanisms. That's true whether you're a W-2 employee, a 1099 contractor, a sole proprietor, or someone juggling both employment and a small business. Now I want to speak to both sides of this audience equally, because tax season hits individuals and small business owners differently, but they're operating inside the same system. If you're an individual filer, January stress usually comes from waiting on documents, not knowing whether you qualify for certain credits, fear of doing something wrong, and confusion caused by online tax advice that doesn't apply to you. If you're a small business owner, January stress usually comes from bookkeeping that wasn't quite finished during the year, mixing personal and business expenses, worrying you missed something, feeling behind before you even open your records. Different worries, but the same underlying issue: uncertainty. And uncertainty is what this season feeds on. From the inside, tax season doesn't look like a trap-filled obstacle course. It looks like volume, it looks like patterns, it looks like returns moving through the system. The IRS is not sitting there in January waiting to punish people who are trying in good faith. They are processing millions of returns using standardized criteria, filters, and timelines. And when you understand that, you stop personalizing the process. Tax season is not about you as a person. It's about your numbers, your records, and your consistency. That's it. Here's the mindset shift I want you to carry into the rest of this episode, and the rest of the season. Tax season is not something happening to you. It is something you move through. When you treat it like a crisis, everything feels urgent. When you treat it like a process, everything becomes more manageable. And that's exactly what we're going to build on this season starting right now. Next, we're going to talk about what actually changed for 2025 returns filed in 2026, what those changes really mean, and why most of them are far less dramatic than the headlines suggest. Let's get into what's new and what actually matters. Let's take a breath and walk through what actually changed for this tax season, because that's what matters most. We're going to look at the inflation adjustments you'll run into most often, new provisions from the One Big Beautiful Bill that impact your 2025 return, and real differences for individuals and small businesses alike. And I want you to hear this first. Change doesn't automatically mean complicated. Most of these are adjustments that keep the system aligned with inflation or specific incentives, not traps waiting to go off when you file. Inflation adjustments you can count on. The IRS updates a handful of key numbers every year so that inflation doesn't push you into higher tax brackets unfairly or shrink the value of your deductions. For the 2025 tax year, the returns you'll be preparing in early 2026, key inflation changes include standard deduction increases, $15,750 for single or married filing separately, $23,625 for head of household, and $31,500 for married filing jointly. These are slightly higher than the prior year amounts, and they help most taxpayers reduce their taxable income just by filing normally. That bump, even if it's modest, matters for nearly everyone because the standard deduction is the default path for the majority of filers. For small business owners who use Schedule C, these adjustments don't change business revenue or expenses, but they do change your total taxable income, and that's important for planning quarterly estimated payments and cash flow. And federal income tax brackets stay the same structurally. There are still 7 marginal tax rates: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The income thresholds that define those brackets shift up slightly with inflation. This means you avoid bracket creep if your income grew simply because of inflation, and you don't suddenly jump into a higher rate just because the cost of living rose. That's a positive adjustment, not a warning sign. What the One Big Beautiful Bill changed for 2025. Now let's talk about one of the biggest legislative drivers behind this year's updates. You've probably heard the name One Big Beautiful Bill, sometimes shortened to OBBB. That tax law took effect for the 2025 tax year and introduces a few notable tax changes you should know about. First off is the new deduction for workers. There are temporary deductions that apply for the 2025 tax year for qualified tip income up to $25,000 and qualified overtime pay exclusion up to $12,500. Both phase out at higher income levels, and they're not credits. They reduce taxable income, but not taxed directly. For someone who earns significant tips or overtime, these can make a real difference, especially for taxpayers who are otherwise breaking even or have tight margins. Next up, we have a bonus deduction for seniors, 65 and older. Taxpayers age 65 and over may claim an additional deduction of up to $6,000 on top of the standard deduction, whether itemizing or not, for tax years 2025 through 2028. That applies per qualifying taxpayer. For someone filing jointly where both spouses are over 65, that's up to a $12,000 bonus deduction. This is temporary, so it's not a permanent part of the code, but it's real for this tax season. And lastly, reporting thresholds for third-party payments. Under the OBBB, the threshold for third-party organizations, that's platforms like payment apps or marketplaces, to issue a Form 1099-K has reverted to the older rule. Typically, reporting is required only if both the transactions exceed $20,000 and there are more than 200 transactions. This is not a change in how you report your income. All income is still taxable whether you get a 1099 or not, but it does change when you receive information returns that trigger software or prepare alerts. So if you didn't get a 1099-K for what used to be a reportable threshold, don't panic. The rules changed, and it's not necessarily a mistake. Now here are some small business considerations. For small business owners, bookkeeping remains the same. Revenue still needs to be accurately recorded. Expenses still need proper support. Business deductions are still based on ordinary necessary cost. But here are the updates worth noting. Mileage and depreciation rules. Business mileage rates typically get adjusted with inflation, and the IRS will release those pretty early in the season. These adjustments don't change your bookkeeping practices, just what number you use for deductions. Information reporting relief. Transitional relief has been provided for certain interest reporting under the OBBB for vehicle loans and other specified items. That's more of a compliance change for payers than a filing change for taxpayers. and the Employee Retention Credit, or the ERC. Limitations on ERC claims for certain periods were clarified under the OBBB, mainly because of how late claims were being filed relative to the original deadlines. That's a specialized issue, but one many small owners hear about in the media. The main takeaway here is simple. The principles of good bookkeeping haven't changed, even if some thresholds or reporting requirements have. The focus remains on accurate records, clean categorization, and consistent systems, all of which we'll talk about more later in this season. So the bottom line on what's new. Let me summarize this in plain language. Inflation adjustments mean a bigger standard deduction and slightly bigger tax brackets, and that's generally good news for most taxpayers. Legislative changes from the One Big Beautiful Bill introduce temporary deductions for workers and seniors and affect how some payments are reported. And small business owners should stay alert for reporting and compliance transition rules, but bookkeeping fundamentals remain the same. Nothing in this list is a sudden trap, and nothing here should derail your focus if you're organized and consistent. Up next, we're going to talk about things people actually worry about and why most of that worry isn't grounded in how the system actually works. Ready? Let's go. Now that we've talked about what's actually new, let's talk about what hasn't changed at all, but somehow causes more stress every single year. Because tax season anxiety is rarely about the law, it's about fear. And most of that fear comes from a handful of assumptions that just aren't true. So let's walk through the biggest worries I hear every January and why they're usually misplaced. If I make a mistake, I'll get audited. This is probably the most common fear and the most exaggerated. Here's the reality. The IRS understands that mistakes happen. They see millions of returns, they expect errors, and most mistakes are resolved through notices, adjustments, or requests for clarifications, not audits. An audit is not the default response to a mistake. It's not even the common response. For individuals with math errors, missing forms, and minor discrepancies, these are usually handled automatically or through correspondence. For small business owners with misclassified expenses, missing documentation, and income types, these typically start with a letter, not an audit notice. An audit is a process, not a punishment, and it's usually driven by patterns, not one-off errors. The IRS is watching everything now. This one gets amplified every year, especially on social media. You'll hear things like, they're cracking down, they're monitoring transactions, they have more funding now. Well, actually, the funding got taken away, but that's another story. And while it's true that enforcement priorities shift over time, that doesn't mean the IRS is personally watching you. Here's what actually happens. Returns are processed through systems. Those systems look for inconsistencies, omissions, and patterns. They don't watch, they filter. If your return is consistent with your prior filings, supported by documentation, and reasonable for your situation, it generally moves right through. This is true whether you're a W-2 employee, a freelancer, a sole proprietor, or someone with multiple income streams. Fear makes it personal. The system isn't personal. I should file as early as possible. This is one of the most damaging misconceptions. Filing early is only helpful if you have all your documents, your information is accurate, and your numbers are finalized. Filing early without complete information is how people end up amending returns, creating unnecessary delays, and triggering confusion when corrected forms arrive. The IRS would rather you file correctly in March than incorrectly in January. Early filing is not a virtue. Accuracy is. If I owe something, I've done something wrong. This one is especially hard for people emotionally. Owing taxes does not mean you failed. You're in trouble or you did something wrong. It often means withholdings didn't match income, estimated payments were off, income increased, or credits changed. For small business owners, owing is often simply the result of profitable activity, timing differences, or conservative estimates earlier in the year. Owing is a calculation, not a moral judgment. And the IRS has options for people who owe, including payment plans, because owing is common. If I can't prove everything perfectly, I'm at risk. This fear shows up a lot with small business owners. Receipts aren't perfectly organized, mileage logs aren't pristine, books need cleanup. Here's the truth. The IRS is not expecting perfection, they're expecting reasonable support. Documentation is about credibility, not flawlessness. Clean, consistent records that tell a coherent story go a long way, even if they're not perfect. Disorganized panic does far more damage than incomplete records ever will. So what does the IRS actually care about? This is where the perspective really matters. The IRS focuses on unreported income, large inconsistencies, repeated patterns that don't make sense, and returns that don't match third-party data. They do not focus on small, good faith mistakes, minor classification differences, and honest attempts to comply. Most people are not on the IRS's radar and never will be, simply because their returns don't warrant attention. So why does this fear persist? It persists because the rules feel opaque, the language feels intimidating, people don't understand the process, and bad advice spreads faster than accurate information. Fear fills the gaps where education should be, and that's exactly what we're addressing this season. So here's what I want you to carry forward. Mistakes are fixable. Owing tax is not a failure. Filing later with accuracy beats filing early with panic. The IRS system is procedural, not personal. When you understand how the system actually works, the fear loses its power. And once fear is gone, decision-making gets easier. Up next, we're going to talk about the biggest mistakes people make in January. Not because they're careless, but because they feel rushed and overwhelmed. And if you can avoid those mistakes early, the rest of tax season gets a whole lot smoother. Let's talk about what not to do next. Most January tax mistakes don't come from carelessness, they come from urgency. People feel like tax season starts with a countdown clock, and once January hits, they think they're already behind. The mindset pushes people into decisions that actually make the process harder, not easier. Let's talk about the biggest January mistakes I see every year and why avoiding them sets you up for a much calmer tax season. Mistake number 1, filing before all documents arrive. This one causes more downstream issues than almost anything else. January is when W-2s are still being finalized, 1099s are issued in waves, corrected forms are extremely common, investment statements aren't always complete. When people file early, they often do it with partial information and then panic when another form shows up later. That leads to amended returns, delays in refunds, and confusion about what was already reported. Here's the key point. There is no prize for filing first. The IRS does not reward speed, they reward completeness. If you're missing documents, waiting is not procrastination. It's responsible. Mistake number 2, guessing instead of verifying. This happens a lot with income totals, expense amounts, mileage, business use percentages. People think, I'll fix it later. I'm close enough. I'll remember. But tax returns are not memory-based documents, they're record-based documents. Guessing leads to numbers that don't match third-party data, inconsistencies between years, and stress when something doesn't reconcile. Verification takes longer up front, but it saves hours later. Mistake number 3, ignoring IRS letters because of fear. This is a big one. People receive a letter in January or February and immediately assume they're in trouble, they did something wrong, and they should avoid opening it. But most IRS letters are informational. They may be confirming receipt, requesting clarification, explaining a minor adjustment, or asking for documentation. Ignoring a letter does not make it go away. It usually makes the situation more complicated. Opening the letter, reading it carefully, and understanding what it actually says is almost always the least stressful path forward. Mistake number 4, DIY bookkeeping cleanup under pressure. This one hits small business owners especially hard. January panic often triggers mass reclassification of expenses, deleting transactions instead of reconciling them, overcorrecting categories, mixing personal and business activity just to get it done. Under pressure, people make bookkeeping worse, not better. Cleanup done slowly and methodically leads to clarity. Cleanup done in a rush creates new problems. And here's the truth most people don't want to hear. January is not the only time to clean up books. It's just the loudest. Mistake number 5, mixing personal and business transactions just for now. This feels harmless in the moment. People think, I'll sort it out later. It's only one transaction. I know what it was. But this habit compounds quickly. Mixing transactions leads to inaccurate expense totals, credibility issues, extra work at filing time, and stress when documentation is needed. Separation isn't about perfection, it's about clarity. Even imperfect separation is better than none. Mistake number 6, letting fear drive the timeline. This is the underlying mistake beneath all the others. Fear makes people rush, fear makes people avoid, and fear makes people guess. Fear rarely leads to good decisions. Tax season does not require urgencies, it requires steady progress. When you slow down, errors decrease, confidence increases, and corrections become manageable. January mistakes are small, but they cascade. A missing form leads to an amendment leads to delays lead to frustration leads to panic. And suddenly, tax season feels overwhelming even when the original issue was minor. Avoiding January mistakes doesn't mean doing nothing, it means doing the right things at the right pace. So here's a better January approach. Collect your documents without rushing. Verify income and expenses. Reconcile records carefully. Ask questions early. Focus on accuracy, not speed. This approach doesn't feel dramatic, but it works. And it sets you up for what actually matters most this tax season, which we're going to talk about next. Because once you stop focusing on everything that feels urgent, it becomes much easier to focus on what truly makes a difference. Up next, we're going to talk about what actually matters this tax season and where your energy is best spent. By this point, you've probably noticed a theme. Tax season becomes stressful when attention is scattered. It becomes manageable when attention is focused. So let's talk about what actually deserves your energy this season and what doesn't. If you remember nothing else from this episode, remember these 3 priorities. Priority number 1, accuracy over speed. Speed is tempting. Accuracy is effective. Filing quickly feels productive, but it doesn't actually reduce risk. In many cases, it increases it. Accuracy means all income is accounted for, expenses are supported, numbers make sense together, information matches third-party reporting. Whether you're an individual filer or a small business owner, accuracy gives you peace of mind long after filing day passes. And here's the important part. Accuracy is not about perfection, it's about reasonable care. Priority number 2, documentation over optimization. A lot of people spend January trying to optimize their taxes. They search for loopholes, aggressive deductions, last-minute strategies, but optimization without documentation is fragile. What actually matters is having records, knowing where numbers came from, being able to explain your return if asked. For individuals, that means keeping tax forms, understanding credits you claim, and retaining key documents. For business owners, that means receipts, mileage records, clean summaries, and clear separation between personal and business activity. Strong documentation turns tax season from a guessing game into a process. Priority number 3, consistency over perfect results. The IRS values consistency more than cleverness. Returns that make sense year over year, reflect normal business activity, and follow a consistent approach are far easier to process and support. If something changed this year, income, expenses, filing status, that's fine. What matters is that the change is explainable. Consistency builds credibility. Credibility reduces stress. So what does this mean for different filers? If you're an individual filer, what matters most is complete reporting, understanding your return, and responding to correspondence if needed. If you're a small business owner, what matters most is clean books, reasonable expense treatment, and knowing your numbers before filing. Different paths, same principles. Here's the mindset shift that changes everything. Tax season isn't about controlling every outcome, it's about preparing responsibly. When you focus on accuracy, documentation, and consistency, you remove most of the uncertainty that causes panic. And once uncertainty is gone, tax season becomes something you manage, not something that manages you. I want to end this episode by saying something very clearly. You do not need to be afraid of tax season. You need clarity, you need context, and you need a steady approach. That's what this season of the Zero Fluff Books Podcast is about. Over the next episodes, we're going to break down common IRS notices, talk about audit myths versus reality, walk through bookkeeping habits that reduce stress, and help you understand the system instead of fearing it. This season is about replacing panic with knowledge and urgency with confidence. If this episode helped ground you, I encourage you to subscribe to the podcast, share this episode with someone who's already stressing, and come back as we continue this conversation throughout tax season. Tax season doesn't have to feel overwhelming, and you don't have to navigate it alone. Thanks for listening, and we'll talk again soon.